Factors to consider when choosing Canadian dividend stocks. Investing in dividend stocks can be a lucrative strategy for long-term investors. Canadian dividend stocks, in particular, have been popular among investors due to the country's stable economy, well-regulated financial markets, and a plethora of companies that have a history of paying consistent dividends. Choosing the right dividend stock requires careful consideration of several factors. Growth potential. The growth potential of a company is a critical factor to consider. A company that is growing will likely have increasing profits, which can lead to higher dividend payouts in the future. Here's how to gauge the growth potential. Earnings growth. Look at the company's historical earnings growth and future projections. Companies with a consistent track record of increasing earnings are often well positioned for future growth. Revenue growth. Alongside earnings, it's essential to consider revenue growth. A company that is increasing its sales is likely expanding its market share or venturing into new markets. Expansion plans. Companies that are expanding, either domestically or internationally, can offer significant growth potential. Look for announcements or plans related to new product launches, acquisitions, or entry into new markets. Safety and stability. Safety should be a top priority for dividend investors. The last thing you want is to invest in a company that cuts or eliminates its dividend. Here's how to assess the safety of a dividend stock. Dividend coverage ratio. This ratio indicates how many times a company can pay its dividend from its current earnings. A higher ratio suggests that the company can comfortably afford its dividend payments. Debt levels. Companies with high levels of debt may be at risk during economic downturns. A lower debt-to-equity ratio indicates that the company is not overly reliant on debt for its operations. History of dividend payments. Companies that have a long history of paying and increasing dividends are often more reliable than those with a sporadic dividend history. Dividend yield. Dividend yield is the annual dividend payment divided by the stock's current price. It gives investors an idea of the return they can expect from the dividend alone. However, a high yield isn't always a good thing. Here's how to interpret dividend yield. Comparative analysis. Compare the dividend yield of the stock with its industry peers. If it's significantly higher, it might be a red flag, suggesting potential issues with the company. Sustainability. A very high yield can sometimes indicate that the market believes the dividend is at risk of being cut. Ensure that the dividend is sustainable by looking at the company's payout ratio and earnings growth. Total return potential. While yield is essential, investors should also consider the stock's potential for capital appreciation. A stock with a moderate yield but high growth potential might offer a better total return than a high-yield stock with little growth potential. Conclusion. Choosing Canadian dividend stocks requires a balanced approach, considering growth potential, safety, and yield. By carefully analyzing these factors and conducting thorough research, investors can select stocks that offer a combination of consistent dividends and capital appreciation. Remember, while dividends are a great source of passive income, it's essential to ensure that your investment aligns with your overall financial goals and risk tolerance.